Gold is at $5,085 per ounce right now. Silver is at $82. And in the Persian Gulf at this very moment, oil tankers are being attacked. Iran has closed the Strait of Hormuz, the single most important oil shipping lane on the planet, and the entire global energy market is in crisis. Now let me ask you a question. Given everything I just told you, given that we are living through what analysts are calling the most powerful geopolitical shock since 1973, where do you think gold should be right now? Higher, right? Significantly higher. That's what every textbook says. That's what every financial channel told you. Gold is the safe haven. Gold goes up in a war. Gold protects you when the world is on fire. Except gold didn't go up. It went down from $5,419 on the day the bombs fell all the way to $5,085 today. Silver collapsed even harder from $9,640 at the peak down to $82 in 11 days. And that single fact, that one deeply counterintuitive reality, is the most important signal in the entire global financial market right now. Not because it means gold is broken, not because it means the thesis is wrong, but because of what it means about what is coming next. There are two types of investors looking at this chart right now. The first type sees gold at $5.85, down from the war spike, and concludes the trade didn't work. They're selling, or they never bought at all because they were waiting for confirmation that never came. The second type sees exactly what the most sophisticated institutional investors in the world see. They see an accumulation window. They see the setup that historically precedes the largest, fastest, most violent precious metals rallies ever recorded. And they are not selling at $5.85. In the next 17 minutes, I'm going to show you exactly why gold fell when a war started, exactly what always happens after that initial drop, exactly why the structural conditions in March 2026 are more powerful than they were in 1973, and exactly what JP Morgan, Deutsche Bank, and the central banks of the world are positioned for, while retail investors are busy reading confused headlines. This is not a gold price story. This is a story about the difference between the short-term price and the structural price, and why understanding that difference is the most valuable piece of financial education you can have right now. Let's get into it. Let me take you back to 3 a.m. Eastern Time on March 2nd, 2026. Operation Epic Fury begins. U.S. and Israeli strike packages hit Iran simultaneously. Within minutes, the reports are reaching trading desks in London, Tokyo, and New York. Supreme Leader Khamenei is killed. The world's most powerful theocratic government has just had its head removed, and the markets respond exactly the way you'd expect. Gold surges to $5,219 per ounce, its highest level since January 30th. Silver touches $9,640. Oil spikes 13% to $82 per barrel before U.S. markets have even opened. Defense stocks gap up. Energy stocks gap up. Retail investors across the world watching the alerts hit their phones at 3 a.m. do exactly what every financial media outlet has spent years training them to do. They buy gold at $5,400, silver at $95, defense names at the peak of the gap, and then something happens that nobody in the mainstream financial press explained clearly enough, fast enough, or honestly enough. Gold doesn't hold. It starts to fade. Then it drops. Then silver collapses, falling as much as 7% in a single intraday session, from $96 all the way back to the high 87s. Within a week, gold is back below $5,200. Within 11 days, it's at $5,085, lower than it was before the war started. The retail investors who bought the spike are now underwater. Not by a little, meaningfully underwater, in a position they took precisely because they thought a war would protect them. And the financial press, the same outlets that spent 2 weeks publishing breathless articles about $6,500 gold and $150 silver, is now running confused pieces asking why precious metals aren't responding to the crisis the way they're supposed to. Here is the answer, and it matters more than anything else you will hear today. The short-term price of gold in a geopolitical shock is not determined by fear. It is determined by 3 mechanical factors that almost always move against gold in the first 2 to 4 weeks of an oil-driven crisis. And until you understand those 3 factors, you cannot understand what is actually happening or what always comes next. The number I want you to remember is not $5.85. It's not $82. It's not even $6,300, which is JP Morgan's year-end gold target. The number is 0.4. 4. That is how much the yield on the 10-year U.S. Treasury bond rose on the morning of March the 2nd. At the exact same moment, gold was spiking to $54,199 per ounce, 0.4%, rising from a 4-month low. And if you want to understand everything that has happened to gold and silver over the past 11 days, you need to understand why that number is everything. Here is the mechanical sequence, and I want you to follow every step because this is what the trading desks that move those markets were running in real time. Iran closes the Strait of Hormuz. Oil surges. Rising oil prices mean rising energy costs embedded into every layer of the economy. Rising energy costs mean rising inflation expectations. Rising inflation expectations mean the Federal Reserve is less likely, possibly unable to cut interest rates. And when the market prices in higher rates for longer, bond yields rise. Now here's the critical connection that most retail investors have never been taught. Rising bond yields are the single most powerful mechanical suppressor of gold and silver prices in the modern financial system. Why? Because gold and silver pay no yield. They produce no income. In a world where you can park your money in a U.S. Treasury bond and earn 4.5% with full government backing, every 0.1% that yield rises makes gold relatively less attractive. Not emotionally, mechanically, algorithmically, the models that drive institutional gold positioning automatically reduce exposure as yields rise. And simultaneously, rising oil prices strengthen the U.S. dollar on safe haven demand. A stronger dollar means gold, which is priced in dollars globally, becomes more expensive in every other currency, which reduces international demand. So the complete mechanical chain looks like this. War in Iran, oil spike, inflation expectations up, bond yields up, dollar up, gold down. The same war that was supposed to send gold to $6,500 created in perfect sequence the exact monetary and currency conditions that suppress gold in the short term. This is not a paradox. It is not a market malfunction. It is the predictable, documented, historically consistent behavior of the gold market every single time there has been an oil-driven geopolitical shock. Precious metals continue to trade largely inversely to oil prices in the short term, precisely because of this dollar and yield relationship. It is the most important and least taught dynamic in the entire precious metals market. And here is the single most important sentence I will say in this entire video. This suppression mechanism has a finite lifespan. It runs until it can't. And in March 2026, the structural conditions that will end it are more powerful, more urgent, and more mathematically inescapable than at any point in the last 40 years. Layer 1. The oil shock is not going away. Let's talk about the Strait of Hormuz because I don't think most people have fully internalized what a closure of that waterway actually means. 20% of the world's entire oil consumption passes through that single narrow choke point every single day. Not 20% of Middle Eastern oil, 20% of all the oil consumed by every economy on Earth. The United States, Europe, Japan, China, India, South Korea, all of it, or a significant portion of it, moves through that strait. Right now, Iran's Revolutionary Guard has shut it down. Over 100 tankers have been halted. 2 vessels have already been attacked. The disruption is not theoretical. It is happening in real time today as you watch this video. Wood Mackenzie, one of the most respected energy research firms in the world, is warning of $100 oil if the closure persists. Goldman Sachs has already calculated an $18 per barrel real-time risk premium that is baked into current prices, and there is no concrete diplomatic or military solution in sight. Every week that Strait remains commercially disrupted is another week of elevated energy costs feeding directly into core inflation numbers. And that inflation, structural, persistent, oil-driven inflation, is the foundation of the entire setup we are discussing today. Because here is what oil-driven inflation does to the Federal Reserve. It traps them. They cannot cut rates into a live inflation spiral without destroying their own credibility. And they cannot raise rates aggressively for reasons I'm about to explain in Layer 2. They are caught. And when central banks are caught, gold eventually wins. Layer 2. The debt arithmetic that changes everything. Here is the number that Wall Street understands and almost nobody on financial television is talking about directly enough. The United States is rolling over $9.2 trillion in federal debt this fiscal year alone. Not the total national debt. $9.2 trillion that needs to be refinanced, re-auctioned, and reissued at current market rates at interest rates between 4 and 5%. Annual interest payments on the national debt have already crossed $1 trillion. That figure is larger than the entire U.S. defense budget. It is the single largest line item in federal spending, and it is growing every single month as cheap pandemic-era debt rolls over into expensive new debt at current rates. Now hold that thought and consider what it means for the Federal Reserve. If the Fed raises rates aggressively to fight oil-driven inflation, they accelerate the debt service spiral on $36.2 trillion in total national debt. The interest burden becomes unsustainable at a pace that forces either massive spending cuts, massive monetization, or a debt crisis. None of those outcomes are politically or financially acceptable. If the Fed cuts rates to relieve the debt burden, they are cutting into a live inflation environment created by a major oil shock that destroys central bank credibility, ignites inflation expectations further, and risks a 1970s-style wage price spiral. They cannot go up, they cannot go down. They are mathematically trapped between the inflation the oil shock created and the debt level that makes sustained high rates impossible. And the moment the bond market fully internalizes that the Fed will eventually be forced to choose between these two impossible options. The moment the market concludes that rates will come down not because inflation is beaten, but because the debt load leaves no other choice. The suppression mechanism reverses. Bond yields fall despite elevated oil prices. The dollar weakens and gold, which has been held down by that yield and dollar relationship, is suddenly responding to both the inflation the oil shock created and the monetary loosening the debt forced. That combination is the 1979 scenario, and it is precisely why JP Morgan has published a $6,300 per ounce target by end of 2026, and Deutsche Bank is standing by $6,000. Layer 3. The silver opportunity nobody is covering. Now, I want to talk about silver because I believe this is where the most asymmetric, most overlooked, most misunderstood opportunity in the entire precious metals complex sits right now. Silver went from $96.40 on March 2nd to $82 today, a collapse of roughly 15% in 11 days. And if you look at financial social media right now, you will find retail investors who bought the war spike at $95 now declaring that the silver bull market is dead, that the thesis was wrong, that it's time to move on. They are making a mistake that will be painfully obvious in 12 months. Here is the structural reality of the silver market that has not changed by a single data point in the past 11 days of price action. Silver has been in a structural supply deficit for 6 consecutive years. The world has been consuming more silver than it mines for 6 straight years. COMEX registered silver inventory, the physical metal available for immediate delivery on the futures exchange, is down 64% from its 2020 peak. China has restricted silver exports as a designated strategic resource. Industrial demand from solar panel manufacturing, electric vehicles, AI data center infrastructure, and defense electronics continues to accelerate regardless of what geopolitics does to the investment side of the silver market. Silver is unique among precious metals because it is simultaneously an investment metal and an industrial metal. When war fears spike, the investment demand side surges, hence the jump to $96. When those same war fears raise recession concerns and hit industrial stocks, the industrial demand expectations get discounted, hence the crash back to $82. Silver swings harder than gold in both directions for this precise reason. But here is what the chart is actually telling you if you know how to read it. The February retest of the $72 support level triggered a powerful and sustained rebound. The cup and handle technical formation that developed throughout the final quarter of 2025 has initiated the next structural leg higher. Silver price models based on the supply deficit, the COMEX drainage, and the China export restriction thesis are projecting a break above $120 in 2026 and a subsequent move toward $150. And consider this. The gold-silver ratio is currently sitting at approximately 57. That means gold is 57 times the price of silver. Historically, when this ratio compresses from its extremes and reverses, silver outperforms gold by 3 to 5 times on the move back. Silver at $82 today relative to gold at $5,085 is not expensive. It is historically cheap against gold. And historically cheap against gold in a structural supply deficit is not a warning sign. It is an opportunity. The retail investor who sold silver at $82 because it didn't perform during the war has confused a pullback within a multi-year structural bull market for the end of the thesis. The price changed. The thesis didn't. Those are two completely different things. To fully understand what is unfolding right now in March 2026, you need to go back to October 1973, because the parallel is not approximate. It is precise, And the outcome of the 1973 setup is the most important data point in modern precious metals history. October 1973, the OPEC oil embargo hits. The Arab members of OPEC announced they will no longer ship oil to nations that supported Israel in the Yom Kippur War, targeting the United States, Western Europe, and Japan. Oil prices quadruple almost overnight from $3 per barrel to $12. Global inflation surges. The U.S. economy enters stagflation, and gold. Gold does exactly what it's doing today. It spikes on the initial shock, then it pulls back. Then it trades sideways, and confusingly, while oil stays elevated, inflation builds into the system, and the financial press writes confused articles about why gold isn't performing the way it should. And then, when retail investors have concluded that gold failed to deliver, when the financial media has moved on to the next crisis, the real move begins. By the time of the second oil shock, the Iranian Revolution of 1979, crude oil had surged over 110%. Gold climbed nearly 150% in just 2 years. And by 1980, measured from the moment Nixon ended the dollar's gold convertibility in 1971, gold had risen 2,300%. 2,300%, not from the moment of the 1973 shock. From the moment it became structurally clear that the inflation the shocks created was permanent, embedded in the monetary system, impossible for central banks to fight without destroying the economy they were supposed to protect. The investors who bought in 1973 and held through the volatility, through the pullbacks, through the sideways trading, through the periods when everyone said the crisis was over and gold had failed to perform. Those investors turned $10,000 into $243,000 over 9 years. The investors who bought the 1973 spike and sold when it pulled back missed the 2,300%. They were right about the direction. They were catastrophically, expensively, life-changingly wrong about the time frame. Now here's the question that every gold holder, silver holder, and retirement account owner needs to sit with today. Is the structural setup in March 2026 more or less powerful than October 1973? In 1973, U.S. national debt was less than $500 billion. Today, it is $36.2 trillion. In 1973, central banks were not systematically buying gold. They were selling it. In 2025, central banks bought 863 tons of gold, their third consecutive year of above historical average purchases. In 1973, there was no 6-year structural supply deficit in silver. There was no China export control on silver as a strategic resource. There was no solar panel industry, no EV sector, no AI infrastructure build-out consuming silver at industrial scale. Every single structural condition that drove the 1973 to 1980 gold move is present in March 2026, and most of them are more extreme. The 1973 parallel everyone is drawing is correct in its conclusion, but wrong in its timing. Gold did not complete its move in 1973, it completed it in 1980. The oil shock was the first structural catalyst. The second oil shock was the accelerating event. The investors who held through both captured 2,300%. The investors who sold the pullback missed all of it. Let me show you exactly what the data looks like right now, because I want you to see what the institutional investors watching this market are seeing. The Federal Reserve meets on March 18th and 19th, 6 days from today. Traders are currently pricing virtually zero probability of a rate cut at that meeting because cutting rates into a live, oil-driven inflation spiral is the kind of policy mistake that destroys central bank credibility for a decade. The Fed will hold, oil will stay elevated, the debt service clock will keep running, and the structural pressure on the suppression mechanism will keep building. The U.S. Treasury is simultaneously preparing to roll over the next tranche of that $9.2 trillion refinancing wave. Every auction, every yield print, every dollar of new debt issued at current rates is another data point tightening the mathematical trap the Fed is already sitting in. Central banks, which purchased 863 tons of gold in 2025 alone, their third consecutive year of above historical average buying, have not slowed their purchasing despite prices already above $5,000 per ounce. These are not momentum traders. These are reserve managers at sovereign wealth funds and national central banks who make decade-long allocation decisions. They do not buy gold at $5,000 per ounce because they think it's going to fit $200. They buy it because their models say something far larger is coming. Consider this statistic because I want it to land properly. Gold has made 17 single-day moves of more than $100 per ounce in the first 9 weeks of 2026 alone. Before this year, gold had made only 14 such moves in its entire recorded history. Combined every year, every decade, every crisis, 14 total, and 2026 has already produced 17. That volatility is not noise, it is not random. It is the precise symptom of a market in which the short-term mechanical price and the structural price have become separated by the widest gap in 40 years. And when that gap closes, when the suppression mechanism reverses, it does not close gradually. It closes in violent, concentrated, fast-moving surges that happen faster than retail investors can react. JP Morgan's targets $6,300 per ounce by end of 2026. Deutsche Bank's targets $6,000 per ounce by year end. Neither institution is issuing those targets based on the short-term dollar yield and oil mechanics that are suppressing gold today. They are issuing them based on the structural conditions, the debt level, the central bank purchasing behavior, the supply deficits, the monetary trap that those short-term mechanics cannot suppress indefinitely. The move that most retail investors are waiting to get confirmation of has already been confirmed by the most sophisticated financial institutions on Earth. The confirmation was published while everyone was watching the short-term price fall. I want to leave you with this, and I want to say it as plainly as I can. Right now, in this moment, with gold at $5.85 and silver at $82, and tankers burning in the Strait of Hormuz and the Federal Reserve 6 days away from holding rates into a live inflation spiral, the window that the short-term suppression mechanism has created is open. The structural thesis has not changed. The 6-year silver supply deficit has not changed. The 863 tons of annual central bank gold buying has not changed. The $9.2 trillion debt refinancing wall has not changed. The mathematical trap the Fed is sitting in has not changed. JP Morgan's $6,300 target has not changed. Deutsche Bank's $6,000 target has not changed. The only thing that changed is the short-term price. And the investors who confuse a change in the short-term price for a change in the structural thesis are the investors who sell at $5.85 and spend the next 2 years watching the move they understood perfectly and timed wrong. The 1973 investors who held through the pullback turned $10,000 into $243,000. Not by being smarter than everyone else, not by having better information, by understanding the difference between the short-term price and the structural price, and refusing to let short-term volatility override long-term conviction. The question is not whether gold is going to $6,000 or $6,300. Every institutional price target says it is. The question is not whether silver is going to $120 or $150. The structural supply math says it is. The only question that actually matters is whether you understand what you're looking at right now. Whether you see $5.85 gold and $82 silver as confirmation that the thesis failed, or as the accumulation window that the short-term mechanics just opened inside a structural bull market that has not changed direction. Because once the suppression mechanism reverses, and in every precious metal cycle in recorded history, it is always reversed, the move will be faster, larger, and more violent than anything that happened in the early March spike. Most investors have no idea what's coming. Now you do. If this gave you something that the mainstream financial press isn't covering with this level of depth and precision, hit subscribe. We cover precious metals, macro positioning, monetary policy, and the structural forces driving the largest moves in global capital markets. Drop your questions and your take in the comments below. I read everything. And if you think I got something wrong, tell me. I want the debate. If you want to go deeper on the silver supply deficit thesis and the COMEX inventory drainage, the full breakdown is in the next video right here. I'll see you in it.